Hi, this is Judith Paquette, and this is the Bank Reconciliation Part 1. Why do companies need to use a bank? Why does anyone need to use a bank? Using a bank is great for internal control. Companies cannot deal in cash only. There's no audit trail, and by having a bank, it creates a double record of transactions. Imagine if a company had to pay a bill and they said, oh, here's $10,000 in cash. There would be no record of it, and they need to track all transfers of cash so that they can prove that they made that transfer. So what do they track? What happens with cash? They track money paid to suppliers or employees, or money that is paid to them from customers. Payments are made with checks. They can also be made by bank transfers, and I think a lot of you who are listening probably do not use checks anymore. You just do automatic transfers, but companies still deal in checks. So let's talk about the flow of money. So the company buys products or services from a supplier or an employee. The company owes the supplier or the employee money, and the company tracks all of this in accounts payable, or for employees, salary, wages payable. Company makes sales to customers, and the customer owes the company money. The company tracks this in accounts receivable. So accounts payable, accounts receivable ultimately affect the cash account when bills are paid or money is received. So we're going to use the term the books in this chapter, and the books refers to the company's T account for cash. Actually, the books refer to all of the company's accounts and the activity and final balances in them. And when you have those final balances, of course, once a month or once every few months, we create the trial balance and then we create the financial statements. But for the bank reconciliation, we're going to be very specific, and when we say the books, we're referring to the cash account or the cash accounts, and this is the company's record. So how does money increase the cash account? By customer payments. How does money go out of the cash account? Payments to suppliers or employees. Increases are debits, decreases are credits. Now there's other ways of increasing the cash account. The company could receive money from stockholders. If they issue stock, you're going to debit cash and credit common stock. There's other ways to reduce the cash account. You could credit the cash account to pay your taxes. So there's other ways, but these are the two ways we're going to discuss today in this example of the bank reconciliation. So here we are. Remember, the company is paying out. Cash goes down when it pays a bill to a supplier or to the employee. So let's take a sample check. Maybe you've never seen a check before. I'm guessing most of you have. You've probably received them as gifts from family members from time to time. So this check is for $2,950. When a company pays a bill to a supplier, let's say it's for $2,950, the company is going to immediately make that journal entry to reduce cash. They're going to credit cash, $2,950, and they're going to debit accounts payable, $2,950. When a company receives money from a customer, here's a sample check for $20. The customer writes the company a check, and that makes the cash account go up. This increases the cash account. The company is going to receive the check, debit cash $20, and credit accounts receivable if it's a customer for $20. Now the company's records, like I said, are called the books. In the previous example, the books show that the company has $32,070 in the cash account. And as I've said, the company cannot deal in cash. It's too risky, and it provides no audit trail. All month long, The company is writing checks to its suppliers to pay its bills. All month long, checks are immediately written up as journal entries and deducted from the cash account. And then the actual check is mailed to a supplier. Now, there are other ways of paying bills. There's automatic with transfers, and you can do that as well. But I want to focus on the checks because I think it's easier to understand as a first step. Now, this can create a timing issue with the bank's records. The company has booked the journal entry immediately, but the bank won't recognize the transaction until until the supplier cashes the check. And also, all month long, the company is receiving money from its own customers who are paying down their bills. The company immediately makes a journal entry increasing the cash account, and then they take those checks and deposit them in the bank. This can also create a timing issue with the bank's records. This ends part 1 of the bank recon.